go over a few of the in-class discussion questions. So we have number 29, and this one specifically is talking about the different judgment traps. So that was in a table, I think in section 5, yeah, or objective 5. But it's things that kind of can get the auditors stuck, and then they end up making a bad decision. So we've got Chen Li worked on the audit of the AHA, and it operates hospitals and other outpatient centers. She's assigned the responsibility to audit the allowance for the patient's receivables. So for the past several years, AHA's accounting policy required that they record an allowance for any receivables that would be set so that the allowance is going to equal any amount of the receivables that are over 180 days past due. So if the patients haven't paid for 6 months, the assumption is those are going to be considered bad debt, and that's the exact amount that should be set aside for the allowance. Prior to audit testing, the allowance in previous years has been found to be that the subsequent write-offs of the patient's receivables have closely approximated the amount that's in the allowance. So that's saying, okay, in the past years, it seemed reasonable to do that. It approximated what really happened. During the current year audit, Chen examined the amount recorded in the general ledger allowance and reconciled that amount to what was shown as their consolidated trial balance in the 180 days past due. So they did the same thing this year. She verified that amount. And then given that the dollar amounts agreed, she concluded that the allowance was in accordance with their policy and fairly stated. However, this is where the little questionable part comes in. While media reports and other industry publications suggested that there were recent regulatory changes in the healthcare insurance that were affecting patients' ability to pay, Chen still concluded that the AHA's allowance was fairly stated and complied with their policy. So I think that's really key. So I mean, it's kind of a long paragraph saying that they're basically doing the same thing they've done for several years prior, and in those several years prior, it always proved out to be accurate. However, because there was some new regulatory changes, it possibly is not going to be accurate this year. So what that is it's the anchoring judgment trap. That if she makes that decision to say, well, I looked at prior years, everything looks good, and she forgets to really look at changes that happened now, she's kind of anchoring on to the past and not adjusting it for any current events. So she would probably be wrong, or she could be wrong. She should take it one step further to consider those current events. Okay, then we have Stephen. He's assigned the responsibility for evaluating the goodwill impairment testing at this metals company. Metals growth strategy is based on acquisition, so they have had experience in performing these annual impairment tests of goodwill. The client has provided Stephen with an extensive information along with detailed schedules that document their testing approach, and they provided him support for their key assumptions that were made by management. Stephen reviewed those schedules in detail. He tested their calculations. And even though his firm has a number of valuation specialists as part of its staff, Stephen decided to not request their assistance in making an independent assessment of that goodwill impairment, given that the client's documentation was so extensive and would have taken too much time of the own firm's valuation specialists to complete. So they're always worried about, you want to gather the most amount of evidence with the least amount of cost. So Stephen is looking at or maybe Stefan, I might be saying it wrong, but I'm going to stick to Stephen. So Stephen is looking at it thinking, wow, they've provided me so much detail. Everything looks great. I'm going to just go with what the client provided. That is an availability judgment trap. So the thing you got to watch is if they were trying to conduct fraud, they're going to definitely provide you with the best documentation so that you think, oh, I don't even have to check that. So then that's kind of what the judgment trap that he got into is just it was so available and it looked so good and he wanted to keep costs down, so he just went with it. Carlos Mina is responsible for auditing the occurrence of the sales transactions at Robertsonville Manufacturing, As a part of his testing, he reviewed the contracts that were signed between the manufacturing company and its customers to determine that the transaction terms justified the recording of sales for the year under audit. In addition, he examined documentation relating to the sales transactions, including the customer's purchase orders, shipping documents, and invoices generated by Robertsville. That evidence examined supported correct recording of sales in the current year. However, Carlos also noticed in the customer's files that there were copies of email exchanges between Robertsville manufacturing sales agents and the customers, suggesting that some of those terms of the sales agreements could be waived at the customer's discretion. Carlos decided to rely on the contract, only on the contract and the sales transactions documentation, to conclude that the sales were properly stated, given that the other information was only included in an email. So that is going to be a confirmation trap. So the confirmation is the tendency to put more weight on the information that is consistent with his initial thoughts. So again, it kind of, he's looking through it thinking, hey, everything looks great. And then all of a sudden you get that one little thing that maybe causes you to question, but he's going to ignore it and just go ahead and go with what he sees. So, really probably what you should do is consider those emails, kind of take it one step further, do some alternative testing just to verify that, some of these customers didn't actually waive some of the terms, and verify that. So that would again be confirmation. Okay, then our last one is Allison Garrett works on a number of audit of technology equipment manufacturers and has developed extensive knowledge and experience in this industry. On a recent audit engagement of financial statements for Zurich Technology, Allison was responsible for auditing the valuation of inventories, including the reserve for obsolescence. Given her familiarity with the industry, Allison decided to conduct a quick ratio analysis of the days in inventory and determined that the reserve was fairly stated, given that it was in line with the reserves established by some of her other clients, again, because she's got an extensive knowledge. She determined that additional evidence was not necessary to obtain because of her experience with those other clients. So again, looking at the different judgment tendencies, that's going to be overconfidence. So she believes that she's an expert in that field and she has all this experience with other clients. She doesn't even really need to test this because it looks all fairly stated when she just does a quick little ratio analysis. So again, that would be overconfidence on her part. Okay, again, those are just minor things, but I think sometimes it's nice to see like real life scenarios when what the auditors kind of go through and where mistakes could be made. All right, then as I pan through here, let's also look at number 33. So 33, we have the following are specific transaction-related audit objectives that are applied to the audit of the cash disbursement cycle. And then we've got specific transaction-related audit objective. Then down below it, we have the management assertion about the classes of transactions, and then the general transaction-related audit objective. So what they're charging us to do is to go through each of these and identify which management assertion we are going to be, which one applies to that specific transaction, and then which general transaction-related audit objective applies to that specific transaction. All right. So we've got our first one, existing cash disbursement transactions are recorded. So I think the key to this one here is the word existing. So we know that they exist. We're trying to verify that they're actually recorded properly or completely, I guess, because that's actually what it is. So it's completeness. So it's going to be 2, it's completeness for the management assertion about the class of transaction. And then it's also going to be 8, completeness for the general transaction-related audit objective. So it's completeness for both of those. And again, I think the key is because we already know they're existing. We're not questioning, do they exist? We're questioning, we know they exist. Are they recorded? Okay, then we have recorded cash disbursement transactions are for the amount of the goods or services received and are correctly recorded. So then when we go down and look at our choices there, we're looking at, are they recorded and are they correctly recorded? So correctness takes us to accuracy. So then that is going to be 3 and then 9. So both, again, same, just the different objectives. I mean, one's the management assertion, and the other one is the audit objective, but so many of them are the same. Okay, then we have letter C, cash disbursement transactions are properly included in the accounts payable master file and are correctly summarized. So now we're talking about where do they end up. So that is going to be over on this side, the posting and the summarization, so that they are correctly summarized and that they are included in the accounts payable master file. So it's the posting and the summarization on the audit side. Now then when you come over though to the management side, you would think possibly classification, and I could understand that the way that it's worded. The textbook actually has accuracy, and I guess too because it says properly included, correctly summarized. So we're looking at correct versions of it, which would be accuracy. But I could kind of see how number 4 could slide in there as well. Okay, then we have D, we recorded cash disbursements for goods or services actually received. So if they're actually received, that's what we're trying to verify. Are they actually received? So then we're not necessarily looking at accuracy or completeness, or are they classified or presented right? Do they actually exist? So then we're up here in the 1 and the 7. So do they actually exist? Did they really occur? So occurrence and existence kind of are the same thing. Okay, then E, we have our cash disbursement transactions are properly classified. So then in that case, it's classification for the management assertion and then classification for the related audit objective. So it's 4 and 11. So again, classified is kind of your keyword there. Cash disbursements transactions are recorded on the correct dates. So now we're looking at the timing. So then that takes us right to 12, the timing for the transaction-related audit objectives. From a client standpoint, it's a cutoff testing. Did I cut off inventory at the right time? You know what I mean? To know if everything's included. Did I cut off my sales and my accounts receivable? All that kind of stuff. So then that would be 5 and 12. Okay, then one last one. Is that true? Let me see. Okay, actually, I got to go back. Sorry. Let me go back to 28. So 28, we have this, I think this is a legitimate real transaction. So this is for information that was obtained that by the SEC after the investigation of fraudulent financial recording for Just for Feet. So Just for Feet was a national retailer of athletic and outdoor footwear and apparel based in Birmingham, Alabama. The company incurred large amounts of advertising expenses, and most vendors offered financial assistance through unwritten agreements with Just for Feet to help pay for those advertising expenses. If Just for Feet promoted a particular vendor's product in one of its advertisements, the vendor typically would consider agreeing to providing an advertising co-op credit to the company to share those costs of the advertisement. Just for Feet would offset this co-op revenue against advertising expense on its income statement, thereby increasing its net earnings. Although every vendor agreement was somewhat different, Just for Feet's receipt of advertising co-op revenue was contingent upon subsequent approval by the vendor. If the vendor approved the advertisement, it would usually issue a co-op payment to Just for Feet in the form of a credit memo offsetting expenses on Just for Feet's merchandise purchases from that vendor. The company's controller and CFO and vice president of operations directed the company's accounting department to book co-op receivables and related revenues that they knew were not owed by certain vendors, including New Balance, Nike, and Reebok. These fraudulent practices resulted in over $19 million in fictitious pre-tax earnings being reported out of a total of $43 million, which is ridiculous. And the SEC ultimately brought charges against a number of the senior executives. So they're asking us some questions like, exercising professional skepticism. So professional skepticism is when we go into an audit with a questioning mind and a critical assessment of the evidence. So like the textbook says, we can trust our clients, but we need to verify it with actual audit evidence. And then B says what circumstances related to the accounting treatment of the vendor allowances should kind of ring a bell in that professional skepticism. So I feel like there's several. I mean, obviously this to me is the hugest. They recorded $19 million out of 43 million. I mean, that's almost half of their revenues were fictitious. How would you not test that? I mean, my God, that if you're talking materiality, that is hugely material. If it was like 1 million out of 40 million, I could maybe understand, but that's just such a huge amount. So that should definitely have raised a red flag. The other thing that could raise a red flag is the fact that none of this is in writing. So up here, what do they say? They unwritten agreements. So they're just like what, verbally talking with these client or these vendors. So that's also kind of crazy. And then obviously they are vendors. They are people who they are buying the shoes from that then they're selling. So they're definitely not independent. They're all kind of interconnected. So I really feel like all the three of those things would raise the red flag to say, I don't know, I think I better do a little more testing on this. Then C says, what factors might have caused the auditor to inappropriately accept the assertions by management that these vendor allowances should be reflected on the financial statements? Again, gosh, you don't know. But probably as we look at what we've kind of read about, this was something that had happened in the past, and if you would become an auditor and you go out into the audit work world, you're always looking at your prior year work papers. I mean, always. So that's like your go-to document. Let's look at prior year work papers and see what happened last year, see what the auditors did last year, because sometimes the personnel changes, but you always want to go back to that. So they would have looked back at last year's work papers and said, oh, hey, they had these same vendor allowances last year and we were fine with it. So that's going to make them feel okay. And then I'm sure they talked to the clients, obviously, because it's such a huge amount, and they must have felt like they could trust them based on the responses. Because again, the thing with fraud is they're going to try to hide it and make the auditors feel comfortable. So again, probably overly trusting the client and then just knowing that it happened in the past. What kind of probing questions could they have asked? I mean, they really could have said, there's nothing in writing. I mean, you don't have anything in writing that shows this. Could we try to trace? Because what it says here is that they would issue them a credit. So then they would get a credit off of their future shoe purchases. Well, let's trace some of those through. Let's trace it to, what was offered to them as an advertising credit, that they accepted it, and then we took it off their payment. So actually just trace the flow of the transaction. And then, I mean, the textbook doesn't have this one, but I would have questioned the difference in treatment, because if we're issuing it as a credit memo to offset future purchases, that's a little bit different than setting it up as a receivable where you would expect them almost to pay you and then record revenue. Because the first part of it, as I read it, and I'm thinking from an accounting standpoint, what would you do? you're gonna offset advertising expense, so you're gonna credit advertising expense, and then you're gonna debit like a payables or something into that particular account, so then you don't pay them. So then the revenues and the accounts receivable are almost like in another sales transaction. I mean, in another part of the company, that also would seem weird. I would question that if I were the auditor. But then, and that they also say then compare the totals to prior years. So was the $19 million just way off from the prior years? So and then that would further open up some additional questions. So I like to do some of these ones where you're actually like looking at a real life scenario, versus just only the concepts, because sometimes it's easier to identify some things or just know, hey, that would be a red flag. So hopefully that helps.